Okay, today's Money Smart Show is on May 11th, 2024. Our special guest today is Ellen Hill. She will tell us here her take on money, how to handle money. And my name is Brian Johnson, President Portfolio Manager of the Moon Run Report. Here's a disclaimer. This talk on portfolio management and drawdown control is designed to educate investors to identify clues to the market based on stock market data. There is no guarantee that any signal will be timely or accurate. Investors should be aware that the analysis here is designed to inform, not avoid all losses that might be incurred. Past performance does not guarantee future results. We're bearish. The Moon Run Report is bearish. Here is why. We went through a shortable correction based on our signals starting on April 10th. There are four things that we look at. The rate of decline, which shows how fast the market is moving, showed it was a correction, not stalling out, going down fast. The number of new lows was sufficient at the top and at the sell signal. And the calculation shows how the force of the downward movement is sufficient too. So we have a shortable correction. Now here, the shortable correction started here at this red arrow and went down and it came back up again. So what's the problem? Okay, the problem is this rally is on low volume, not confirming by a buy signal anywhere at all. And on Friday we had a bad market. So anyways, we started November off smartly with a buy on November 14th, went up here and came down. This was a sell signal, was not confirmed to be a bear market. So we just stayed in and we wrote it up again. And now we came out. So we have a nice gain from all that motion. Now it's sometimes news, hype and action, that type of thing. So we are out of the market mostly at this point. Here's the market strength indicator. We show how strong the market is. It is getting stronger at this point. But we have no buy signal yet, so we're just waiting for the next the market action to tell us what to do. Okay, here's the confidence index on the New York Stock Exchange. The NASDAQ is down here. As you can see, it moved up smartly from November up to this point in April, and again, the NASDAQ turned south, but the New York Stock Exchange was fairly strong, okay? And we have in fact, in our Moon Run Report website, we have a portfolio that's taking advantage of the strength in the New York Stock Exchange today. So we have a downward action and an upward action, and now we go to the next trade. We have the internals, okay? We measure this by this is a compendium of the advances and declines, new high, new low, and up, down volume. And we calculate this and plot this according to a moving average. It has not crossed yet, so we're basically defensive here, waiting for things to happen, but it's not, the action in the stock market is not strong, so we're just waiting, okay? That's the problem. The Moon Run Report and how you can use it. Okay, we have several portfolios on our website. Moon Run Report, $10 a month. First month is free. And the intent is to invest in proven portfolios to generate high returns when we're in. And we sell out before a bear market hits, and then we buy after the bear market is over. My track record. Okay, I'm a two-time world champion. I'm doing 20% a year since 2008. I am number one for the past 12 months, according to Holbert Financial Digest, and I called 3 crashes. And my research began in 2005. What the Moon Run Report contains: small cap, minor cap, mid cap, large cap, FANG stocks, index funds, ETFs, and a portfolio that does not use timing. I have 50 stock portfolios on portfolio 1, 2, 3, designer models, and also something called a Greyhounds of the Dow, which Greyhounds of the S&P, what actually is doing very well now. The charts describing indicators for market direction in the World Moon Run Report. Bear market signals, when to get back in. And I have weekly updates on the Friday nights. And then if we have to replace a stock, we do that on Monday morning. Examining the portfolios. This is how well you can do in the market if you go in with our portfolios when they are active. Small caps back tested from 1990 to this year, about a 50% gain per year, compound average growth rate. That's pretty darn good. Maximum drawdown, 36%. That's actually pretty good, given that it was during the downturn in 2008. Turnover rate, a little bit high, but that's what you expect in the small caps, okay? And then we have a chart to see how well it performs. Now, this is 2,600%. That's what it reads, 2,600%, or actually 2,800% you would have gained since 1999. Of course, that is a back test. Past performance does not guarantee future results. The minor cap portfolio looks at stocks from 500 million to 2 billion market cap. 1999 to 2024, pretty darn good, 24%. Maximum drawdown, 25.9%. That's pretty darn good too. So we have that performance, and we look at the chart, 24,000%. That's not too bad at all. Mid-cap portfolio, back test from 1999 to the present, 25% gain, 18% max drawdown, and a turnover rate, replacing 10 stocks a year, and that's not too bad. From market cap between 2 and 10 billion. And here's the chart, 32,000%. Too bad. Large cap portfolio, this is a dandy, back tested from 1999 to 2024. You won't see too many large cap portfolios doing this, 23.87%. Max drawdown percent, 26%. Turnover rate, 138.84%. Okay. And we look at the Russell 1000 for our large caps. And here's the chart, 32,000% from 1999 to the present. Altogether now, combine all the portfolios, 31%, 31.96% average compounded growth if you did all of them. And max drawdown 20%. So here's the chart if you had invested all those portfolios, 110,000% from beginning of 1999, of course. And we keep on going. Now, a pause to refresh here. I am number one in Holbert Financial Digest for the past 12 months. I think it was ranked on April 30th. 24.47% beat the S&P, and I was close to Fidelity Monitor Insight, but I came out ahead by 0.02%. But I think going forward, I should be doing very well because my models keep on cranking away, and we'll see how they do. But to be in the top 5 is commendable, and just to be number 1 is outstanding. So how much $100,000 becomes after 10 years of investing in these? You can see the figures here. Combined is 1.6 million from 100,000. That's 10 years. After 15 years, combined is 31.96% a year, or 6.4 million. And that is that's how well you can do with $100,000. So we've been able to deliver results. No one calls bear markets like Brian. We have these 2-minute snippets on YouTube. You go into YouTube and then you put in the Money Smart show, and then you see all these 25 or 26 various different 2-minute videos. So 1987 to the present, and various commentary on bear markets. Okay, I'm going to do a little discussion on 50 new lows rule here. This one signals when you should come out using these qualifications. It happened in 1998, 2002, 2000, and also in 2015. It showed up near the tail end of the year and preceded a big drop in the market. So 50 new lows. What we do is we normalize the new lows. We take a calculation to make sure that the new lows that show up year after year are consistent using an average, and we normalize that. And so if it's 50 new lows or more at the top of the market before the drop, then that's a qualification. We don't use the rate of decline. The tsunami indicator, market strength, market strength indicator has to be lower than 4.5, and market strength indicator has to be lower than 3.8 at Celsius. Now, the market strength indicator, like I showed you at the graph before, when I showed the how the market was doing, that was above 3.8 at the top right now, but it moves between from above 4.5 to below 3.8. Then when it's below 3.8, you got to watch out. Right now, it's but anyways, the VIX, the volatility index, has to be between 19 and 25, and that is the sweet spot. So here's an example. The chart following will show you the drop. A sell signal came in on March 20th in 2000. Then we have a number of new lows show up, a lot of them. The market strength indicator weakens at the top and the sell signal, and the VIX came in at 22.96. So year 2000, 50 new lows rule, here it is. You can see this bubble started here in October of 1999, zooming up here, and then everybody thought the market was just going to go and go and go. We came out with a book, Dow 100,000, that's during that period of time. So everybody was excited, and then we get the sell signal, and poof, the whole thing goes to pieces. So the 50 new lows rule shows up here, and then the PEP indicator says the buy signal came here to go inside. So we have the 1998 bubble, and then the 50 new lows rule showed up here, and then we have a buy signal down here when the PEP indicator was greater than 3.8. Okay, that's our slideshow. I will stop sharing, and we have our special guest today, Ellen Hill, and she will take us from here. Ellen, do you have your slides ready?
Yes. Now I just got to remember how we go ahead and share. Can you see my screen? Are you seeing my presentation?
I see you right now. I don't see the presentation. If you select it, we could be able to get that up.
Ellen, you need to click on the share screen.
Share?
Yeah.
Oh, okay. Here we go. Yep. Share. And we go window and we share and share. Do you see it now?
Yes.
Okay, awesome. Good morning, everyone. I was, asked by Brian to come on and just kind of share real quickly some little tips on how money works and how to better manage your money so that you can have extra money to participate in Brian's program. So I would like to keep my presentation really simple because most people do not understand simple fundamentals of how money works. We are all using those strategies not for ourselves, but against ourselves, which is not a good thing, right? So let me go here. All right. Brian, let me know if the slides are not changing because when I'm full screen, I can't see your screen, what you are seeing.
We're on screen number 2 right now. You're doing it's a success.
Okay, cool. Last month in April, I go back to this, we have 3 different books here. The first one was How Money Works, Stop Being a Sucker. I apologize if anybody takes offense to the word stop being a sucker. It's mainly because when we go into banks, they will give us little suckers, right? That's sitting out in front. And many of the suckers are also named dum-dums. So the creator of the books, Tom Matthews and Andy Horner, decided to use that. Then one of my colleagues started a book, How Money Works for Women. because women is a one group that nobody is helping to educate. I have been a financial advisor for 27 years. However, I pride myself in being a financial educator first and foremost. And so I can sell you, if I'm a car salesman, I can sell you a Ferrari. But if you do not know that a Ferrari is an upper end car, it needs super gas, and you drive it like a Kia, no offense to Kia, but they are different categories, your Ferrari will not work the way it's supposed to work. And that's what we are doing. So she wrote this book in conjunction with Sharon Lechter, who is very well known in the book industry. She co-authored the books with Robert Kiyosaki, um, the Rich Dad Poor Dad series. She also was commissioned by the Napoleon Hill Foundation. Napoleon Hill wrote the book Think and Grow Rich. If you have not read it, I would suggest that you read it. It's an awesome book. And she's rewrote the modern version, Think and Grow Rich, 3 Feet from Gold, because we all tend to quit 3 feet from goal because we don't see the results, and the results are just around the corner. Then we have our new ebook called Change Your Life, Change Your Literacy, Change Your Life. And that's our first ebook. So feel free to get on my website. You'll see the website is howmoneyworks.com/Ellen Hill, and you can download the ebook for free. Okay. Then let's take a look at what retirement and savings are all about. This slide will tell you that most everybody today need at least 1.46 million to live in retirement and not to outlive their income. And it surprises a lot of people because they go, really? I said, yes, think about it. Who would have thought years ago that a loaf of bread would now cost $7? A gallon of milk can be $4, $5, $6, $7 even. So Americans aren't saving enough. And we know that. And we've looked at statistics. Those aged between 35 and 44 have only about 41,540 in their retirement accounts. Those aged between 45 and 54 save only 91,130. Between 55 and 64, which is very close to retirement, they've saved a max of 72,520. And those from 65 to 74, 100,250. As you can see, it's way below what they actually need. Okay, that's an eye opener. And if there's anything today is I want to help open your mind, but at the same time, I want to give you hope. It's never too late. Simple interest versus compound interest. Brian, if you listened to his presentation earlier, had covered compound interest. What is simple interest versus compound interest? What's the big deal about this? Well, it's the difference between a constant drizzle or a drizzle that builds to flood waters. You know, my grandma always said, tiny drops of water, a mighty ocean it will make. However, it depends on where it's dropping into. So simple interest is when they give you a percentage off, like say if you had 10,000, they give you 2%, then you will get 2% on your 10,000. Compound interest is when you have your 2%, so now your 10,000 is $10,002, then it will be, the 2% will be on the 10,002. So it's interest on interest. And that's why your money will build faster if you start looking for compound interest. Here's a little secret for you, is that many credit card and loan companies charge compound interest. That's why it's difficult for many people to get out of debt, because it keeps piling and piling, interest over interest. Okay. This is a very important rule. If there's anything you learn today, is this one rule, because it would tell you exactly how many years your investments will double, depending on your interest rate, which is we call your rate of return. And it will also tell you, remember I said it can work for you, it can work against you. When it works against you, the interest that you pay on your loans, if you don't pay them off and you keep paying minimum, remember it's interest over the interest, you will never get out of debt. Okay, so how does this work? If you take 72 divide by your interest rate, most of us put our money in the bank. And if you have not looked at your bank statements, take a look at your bank statement. See what rate of return the savings and the checking is giving you. I can tell you it's less than 1%. But let's just say they give you 1%. You take 72 divided by 1, you will get the number 72. That means it will tell you if you had 10,000 saved in your bank, 72 years later, your money will double to 20,000. Now, how many 72 years do each of us have in our lifetime? If we're lucky, we will see one. We don't know. There are people that die at 40, 50, 30. Even young kids are dying from different diseases now. We're living in a very different world. So what if they charge you 3%? That's 24 years your debt will double. If it's a 6% loan, it's 12 years your debt will double. If it's 9%, it will be 8 years your money will double. If it's 12%, it'll be 6 years your loan will double. So take a look at your credit card, and I can promise you, if you take 72 and they're charging you 24%, guess what? In about 3 years and some, your debt will double. So let's take a look at now in the investment part, and you see it. So what it tells you, find where you can have your loans to be lower than your investments, because you want to bring in more money and use less money. Now it's the other way around. People are bleeding out at higher interest loan rates, and they're bringing in less than 1%. How can you win the money game? You cannot. You are behind the 8 ball every time. You cannot win the money game, right? So this is very, very important. Like I said, this is the one slide. If you can remember, copy, remember it. This is what will change your literacy and change your financial position. Now let's talk about the time value of money. I have had, in the 27 years I've worked with families and individuals, the things that they tell me is, Ellen, I don't have money to save. I said, okay, let's see here. If you take an 18-year-old who left school, could not afford to go to college, did not want to go to college, and went out and worked, got a job, and was paid only $25,000 a year, annual salary, no more, no less, worked at that company from age 18 to 65, that is a 47-year time frame. So if you take the $25,000 a year, multiply by 47 years, it will give you $1.175 million. This individual would have made 1.175 million, yet the same individual will retire at age 65 and not have enough money to live off income, would be, need Social Security to help, we don't know if Social Security is going to be around, right? Plus, this individual will retire broke, and when they die, their family had to go start a GoFundMe account. That is wrong. That is morally wrong for us to leave that sort of legacy for our future generations. However, we don't know what we don't know until someone says something. Like I even learned from Brian's presentation, and I had an aha moment. Once you have an aha moment, like a rubber band, when you stretch it and you let it go, it will retract, but it will never ever go back to its original size. It will be stretched a little, stretched a little, stretched a little, right? So the longer we wait, the more we have to save. So what do I mean by that? Time value of money. Time is one commodity that once it's used, once it's lost, it can never be regained again. I don't care who you are. You can be the Pope, you can be the president. You cannot get time back that is lost. Money, if you lose everything, you can get it back. Even health, when you lose your health, if you get on a strict diet and you take medication, you can kind of get some of that health back, not time. So what do I mean is the longer you wait, you want to put time on your side besides the rule of 72, right? So if you, for example, have a goal of 1 million by retirement, if you started at age 20, you would need only $113 every month to save to have $1 million in your bank at age 67 when you retire. If the same individual said, nah, you know what, I don't have money, I want to have fun, I'm going to go buy a car, I'm going to buy a Tesla, and waited and started at age 40, it's now they were to hit the same goal, they need $731 a month. How many people you know that can save $730 a month, right? It's tough. Some can, some cannot. And if you waited till you're 60, you would need $8,589 to hit the same goal. Because why? You only have 7 years versus 27 years, 47 years, right? So you want to start now. You want to get rid of debt now. You want to free up money so you can save for a solid retirement, right? So, and then you be patient. And one of the things Brian will tell you too is market goes up and down, up and down. However, the market is, over history of the market, it has always been on an upward trajectory. Now, again, like Brian says, past performance is no guarantee of future results. Why? Because it's a roller coaster ride. However, if you stayed invested in the market and you ride the wave, you will come out the other end much better than if you do knee-jerk reaction and you go, ah, the money, I'm losing money, let me sell it. Because when your market, your shares are in the market and it shows a downward trend, it is only paper loss. It becomes a definite solid loss when you knee-jerk reaction and you sell it, because nobody knows when the upward trend will or when the downward. You with Brian's, checking the market, he can more or less tell, but even he cannot. There are financial institutions that have trillions of dollars invested in algorithms and machines, and even they lose money. But what they can do is mitigate the risk. But nobody knows when that curve, upward curve or that downward curve. So you want to be invested in the market. What you also want to do is take a look at having options that are available to you, so that when the market is down, put your new markets in the index accounts, because index accounts and the markets work in opposite with each other. So that way you can mitigate your risk. All right. And that's very important. Let's talk about what is wealth equivalency. So if you look here, is the savings that you would need if your account only pays 5%, and 5% is much better than the bank. The bank don't even give you 1%. Now look at what she says. What if we won't have enough saved for the income you want? A more realistic option may be to start a business that pays you the equivalent. That's just one. But not everybody can start a business. It is not easy starting a business, right? You have a lot of things that you have to pay for, which is not the same as when you get a job. So having a job and having a business is not for everyone. It all depends on an individual. Now, the savings needed at 5%, if you had 240,000 saved, you could have a potential income of about $1,000 a month. Okay. Now, depending where this 240,000 is invested, if it's in your 401, your mutual funds, your stocks, you have to factor in this $1,000 will be less your taxes, right? Because we have to pay taxes. It is incorrect to think, well, I'll be retired, so I won't have any income, I won't be taxed. No, there are so many different categories of taxation. If you have investments in a 401 or a Roth or IRA, not a Roth, an IRA, when you take money out, you will be taxed an ordinary income tax, which is currently the same as earned income tax. They're two different categories. So people think, oh, well, I retire, I won't have money, won't need to pay taxes. The only time you don't pay taxes is when you retire dirt broke, dirt poor, because you don't have any money for them to tax. And other than that, the two guarantees in life, we cannot say we can guarantee rates of return, but the two guarantees we can guarantee is death and taxes. And when you die, they tax you the most. Why? Because we're not around to object, right? So if you had 1.2 million saved, you will get a monthly income of 5,000. 2.4 million, about 10,000. 6 million, 25,000. That's why the rich understand these things and they live even well into the retirement age because they have saved millions. They have understood this concept, which we
Ellen,
need to.
Ellen,
Yes.
we need to wrap up. Do you have
Okay.
more to say on this?
Yeah.
We're near the end of the show.
Yeah, this is just the 7 money milestones, real quick. Take a quick look. And then here is the life insurance that you would need. Life insurance has come a long way. And the lack of literacy is very important. These are people's spending habits. If you cut down your spending, you can save all this money and hit your goal. And that is the end. Thank you for giving me this opportunity.
There you go. Well, thank you for another show. We have another show, and that's it. Thank you very much, Ellen. Very comprehensive. We enjoyed it very much, and very happy to have you on the show. Okay, another Money Smart show. I'll see you next week. We have another guest named Troy Thompson, and he'll have his take on money too. Thank you very much, everyone. Have a nice day.
Have a great weekend. Bye.
Bye-bye.